Be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Vibha Padalkar, MD and CEO of HDFC Life Insurance Company Limited. Thank you, and over to you, ma'am.
Thank you, Zico. Good afternoon, everyone. Thank you for taking part in this conference call to discuss the business performance for 9 months ended December 31st, 2023. Our results, which include the investor presentation, press release, and regulatory disclosures, have already been made available on both our website and the stock exchanges. Joining me are Suresh Badami, Deputy Managing Director, Neeraj Shah, ED and CFO, Ishwari Murugan, our Appointed Actuary, and Kunal Jain, representing Investor Relations. I will share key highlights into 9-month FY24 results and will be glad to take questions thereafter. Starting with operating performance. Our individual WRP grew at 6% for the 9 months ended December 31, 2023. Private market share for the period 9-month FY24 stood at 15%, and we continued to be ranked amongst the top 3 life insurers across individual and group businesses. Whilst quarter-on-quarter sequential individual APE growth was 8%, it has been lower than our initial expectations, largely due to a slower pace of recovery in ticket sizes above rupees 5 lakhs. However, there is sustained positive traction across ticket sizes up to rupees 5 lakhs. These cohorts continue to deliver well, clocking 3x overall company level growth. Encouragingly, we are witnessing indications of a resurgence in the high-ticket segment, particularly in some of our recently introduced products. Additionally, we have noted a shift in asset allocation trends in favor of equity investments influenced by the current buoyant market. We have also witnessed postponement in demand from specific cohorts due to the prevalence of high short-term interest rates. Nonetheless, we view these as temporary challenges and anticipate an uptick in growth as these macro trends gradually normalize. The number of policies sold continues to clock a healthy growth of 9%, outpacing private and overall industry. This aligns with our core objective of establishing a sustainable long-term business by broadening our customer reach. We have covered close to 5 crore lives across our individual and group businesses. Growth from Tier 2 and 3 markets remains strong, witnessing 2x company growth. These markets contributed close to 65% of the overall top line. Average ticket size has remained stable despite the impact on high ticket size business. Our retail protection grew by 36% based on individual APE, and Credit Protect clocked 21% growth YOY. Overall and retail sum assured registered growth of 38% and 54% respectively, with us continuing to be market leaders amongst private players in overall sum assured. Our private market share based on overall sum assured stood at 19% for 9 months FY24. Annuity and protection put together contributed to over 50% of new business premium in 9 months FY24. Towards the latter part of Q3 FY24, we introduced Click to Achieve, a groundbreaking product in the non-par savings category, distinguished by several pioneering features. This innovative plan empowers customers to create unlimited combinations, tailor their cash flows to align with personal goals with the cushion of a guaranteed return. The customer can also reduce the impact of inflation on income with increasing income option. It also provides the flexibility to grow survival benefits at a rate of 1.5% higher than savings bank deposits. The product has been received well across channels and garnered 100 crores within 4 weeks of its launch. This is our second 100 crores in a month blockbuster product to be launched this year. Product mix remained balanced with non-savings and participating products at 28% each, ULIP at 32%, annuity and protection at 7% and 6% respectively, based on individual APE for 9 months FY24. Notably, the non-par mix saw a 200 basis point increase sequentially, largely driven by the successful launch of Click to Achieve, reaching an exit run rate exceeding 30% in December. ULIPs have seen an increase on the back of thriving equity markets, including in the rupees 2.5 lakh and above segment. Moving on to key financial and operating metrics. Despite shifts in our product mix and ongoing investments across channels, new business margin was sustained at 26.5% for 9 months FY24. This reflects our calibrated approach across multiple levers, including pricing, cost management, and underwriting, even amidst market disruptions. As indicated earlier, we have also been able to improve profitability across product segments. Value of new business increased by 5% year-on-year to rupees 2,267 crores. Embedded value was at rupees 45,173 crores as on December 31st, 2023, with an operating return on embedded value of 16.5%. Profit after tax for 9 months FY24 was rupees 1,157 crores, i.e. a year-on-year increase of 16%, supported by 18% growth in profit emergence from our back book. Solvency as on 31st December 2023 was 190%. Renewal collections continue to hold strong with a year-on-year growth of 15%. Next, on distribution. We registered a year-on-year growth of 17% across our bancassurance partners, whilst maintaining a counter share at HDFC Bank, benefiting from a strengthened group relationship. We are also happy to have extended our presence across bancassurance partners and expanded our personnel in their bank branches, whilst deepening collaboration via various initiatives such as blockbuster products, bespoke training, and on-ground engagement. These efforts are dedicated to amplifying customer value and experiences. We are glad to announce our new bancassurance partnerships with Karnataka Bank, Karur Vysya Bank, and NKGSB Cooperative Bank, and we are confident of growing with them over the next few years whilst offering their customers a range of innovative and customer-centric financial solutions. Our agency channel delivered growth in line with the company's performance. We added more than 50,000 agents in the channel during 9 months FY24, and we continue to build a robust proprietary franchise. Our strategy focuses on strengthening our distribution network by expanding branches, attracting relevant distributor profiles, and making consistent investments in technology and capability building. Amongst other highlights, we are pleased to announce the addition of Mr. Kaizad Bharucha, Deputy Managing Director of HDFC Bank, to our board. His expertise is a valuable addition, and we eagerly anticipate achieving significant milestones under his mentorship as a board member. Moving on to regulatory updates. As you are aware, IRDAI has published an exposure draft on insurance product regulations in December 2023. One of the key aspects in the draft is a proposal to address the concern on early surrender values in traditional products. The draft is currently under discussion, and the industry is in the process of sharing its feedback with the regulator. We believe that the product design should offer the best value proposition to the customer, whilst encouraging long-term commitment to the product and without compromising growth for the sector. Further to the update on the GST show cause notice issued by Director General of GST Intelligence, DGGI, raising a demand in June 2023, the company has filed its detailed response on January 5th, 2024 with the adjudicating authority. We are happy to announce our recent accomplishments, being honored with the prestigious Golden Peacock Award for Excellence in Corporate Governance in 2023 and achieving a Guinness World Records title through our 2023 Insure India initiative. This initiative was designed to heighten awareness about life insurance across the nation. In conclusion, as protection gap in our country continues to widen, we remain focused on offering solutions to tap into this vast opportunity. Growth in the rupees 5 lakhs and below category, as well as in tier 2 and 3 towns, remains robust, and these are our focus areas. Even for the growth potential of the above rupees 5 lakh ticket sizes, we hold an optimistic outlook for the medium to long term. We expect to grow by leveraging multiple drivers, including strengthened counter share at HDFC Bank, capitalizing on ongoing investments such as branch expansion and new tie-ups, continuing to scale up a high-quality proprietary business led by agency, and favorable macroeconomic shifts. The detailed disclosure on our results is available in our investor presentation. We now invite any questions from the audience.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Suresh Ganapathy from Macquarie Research. Please go ahead.
Yeah, hi, Vibha. The first is on growth and margins itself, Vibha. I mean, my point here is at the start of the year, you said a 15% guidance, and the actual outcome, unfortunately, has been well short of that. And so far, 9-month number has just been 5%. I mean, is this not getting? I know the smaller ticket size policies have done well, but the sheer contribution of the larger ticket size, you're confident that post we exit FY24 with the revised guidelines on surrender charges and stuff, we can get back to the mojo of getting 15% AP growth and perhaps VNB growth? What gives you the confidence there?
Yeah, so a couple of things, and I'll come to the draft surrender related the draft circular. As far as on a standalone basis, I have no doubt in my mind about getting the mojo back, and that is very evident in a few things. One is, like I mentioned, the below 5 lakhs is growing at, we've already grown by 17% and continuing to grow. That is number one. Number two is that it's also a function of equity markets and unit links. We've always used a balanced product strategy, and so we will remain calibrated until some of that happens, and it's bound to happen in the time frame that you're talking about. A little bit of calibration in terms of exuberance and getting back to principles of more broader asset allocation. Another point is that in terms of the counter share at HDFC Bank also, because this year that counter share wasn't there for the full year, so you'll have a full year impact of counter share, and slowly and steadily continuing to solidify and make inroads in the bank. A fourth point is all the onboarding of new relationships. 3 I mentioned, there are some smaller ones that I haven't mentioned, but all of those will start kicking in, and wherever we have gone in with a new relationship, we have ended up with a counter share anything between 30% to 40% over a span of the first 15 months or so. So that also will start happening given the strength of our product offering. And if you were to look at on the agency channel also, you'll see that there's 75 new branches that we are adding. So that also would start seeing that in terms of traction.
No, but the problem, Vibha, is peers have done better than you, right? Which is pretty rare. I mean, for you guys not to outperform your peers. So this is the first time perhaps in the history where you're underperforming the peers by a wide margin. I mean, everybody is in the same boat when it comes to all these challenges with respect to high product ticket sizes, right? I mean, so just to understand that, yeah.
So Suresh, when you look at, since you're talking about peers, we would like to point out that we have not dropped margins. So if you versus peers, there has been a fairly significant margin drop. So if there's a margin drop, then selling more of unit linked as a percentage, perhaps more aggression on some of the products is not very difficult. So we continue to stay focused on triangulating all objectives, whether it is in terms of growth in term, whether it is in terms of growth in annuity, whether credit life, whether it is in holistic renewal premium. If you look at assets under management, numbers are yet to be out, but we have grown 20% in terms of assets under management. So just the quality of business, protection of the kind of business that has already come in, and for us to continue with that. Number of policies also, if you look at, we are the market leaders in terms of retail number of policies. We've grown by 9%. So the reason I'm pointing all of this is that is the holistic scorecard. It is not very difficult to just grow EPI just for the sake of growing EPI. I think it is the philosophy that I want to tick in every box, because it's not just growth for this year. Growth for this year will hamper growth for next year. If I don't grow on number of policies, then it is going to hamper how much I'm able to mine next year. So sowing those seeds, sowing tier 2 and 3, broad basing, that is important. Or even if you look at another metric, on agency channel, we are right up there on number of agents that we have added, 50,000 agents plus that we have added this year. So no let up at all in terms of number of agents that we are able to add and attract to that. So I think that is the kind of, that is the reason why it gives confidence. Yes, this year we have deconstructed in terms of the below 5 lakhs and above 5 lakhs. And we are quietly confident that, whether it's high single digits or 11-12%, that kind of a thing will, the gap will get made up. So I think whether it's, the remaining focus, another aspect I want to mention, very, very important, is the overall sum assured. That grew by 38%, and again, it's not just one quarter. Every quarter we've been the market leaders on sum assured, and this is, I'm talking about overall. And if you look at retail sum assured, that has grown by about 50%. So very, very strong in terms of retail sum assured. So all of that is making it possible for us to be neutral on margins, continue to give growth in value of new business, and grow step by step. I think that core of our business ultimately is in protection. So while we will grow in savings, but we will calibrate all of these measures.
And the IRDA regulations, and what do you think on the non-par, both from a growth standpoint, surrender chance standpoint, margin standpoint, behavior standpoint? Can you just because everybody is going to ask these questions, so for the benefit of the audience, can you just, Yeah.
Absolutely. So, see, philosophically, we are completely aligned with the regulator that where a customer wants his own money down the line, thinks they've bought the wrong product, how do we give some level of exit or protection of their capital? However, a few things here in terms of, how do we get there? So philosophically, no disconnect, but the how part of it is what we are engaging as an industry with the regulator. We've had a few discussions as well, and we'll continue to do that. For example, the circular already has a few enablers, which currently we don't have. For example, we can have shorter tenured products. There is some no GST on certain types of ticket sizes or sum assured. Those sorts of things will anyway give us somewhat of a kicker. How we do the cash flow matching on a longer tenured product? Can we have a discontinued policy fund kind of avatar, which is already there in unit linked as a construct? So, for example, in unit linked products, if somebody were to surrender, then it goes and sits in the premium sits or the fund sits in the discontinued policy fund, and so you're discouraging just immediate churn, but at the same time you're protecting someone's money. They don't want to pay or unable to pay future premiums, so you're protecting them. So it's those sorts of things. If they come through, then this will help mitigate. That is number one, and also is very much in line with what we are used to as a nation on longer term products. For example, PPF. None of us worry about the fact that before 7 years we can't even get some element of it. It's only after 7 years there's a formula. We're all used to it. So these have different objectives rather than just giving liquidity. So we are of the right now we're at a stage wherein we are explaining and engaging with the regulator. Not that they don't understand these things, but they're very receptive to hearing from us. And we'll see how and in what avatar finally it makes sense for the customer, manufacturer, intermediary, and the regulator. So that's where we are right now. But I do believe that even the product construct, I don't want to give away too many. There are at least 5 or 6 different ideas that we have on product construct. One I will share, for example, can we have a differential kicker for someone who says, I don't want liquidity, but I want that kicker on IRR, for example. So many such ideas are there, and it's really in the nuances of what the final shape or form will be, wherein there will be a business case to it. So that's where we are, and will take some time for us as a sector also to deliberate.
Okay, thanks, Vibha.
Thank you.
Thank you. Next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. Couple of questions. First one again into around the product and our strategy. that we want balanced product mix. The question here is that, this is a sector heavily regulated and regulation keeps evolving. And also so is the market condition, be it your interest rates or equities. Should not, in that backdrop, it be sort of the ability of the company franchise to offer what the market is demanding, customers are demanding, or what sort of a distributor can distribute, rather than having, because some way by just sticking to a certain product mix strategy isn't, or aren't you sacrificing the growth opportunity? And if, of course, you have already explained a lot on this regulation, but if regulations were to come hard on a certain product, then you will have to sort of move away from that product. So why not have a strategy that's sort of agnostic to the products and ability to sort of distribute the products widely? So that's one. Second, looking at the agency part, any particular reason why sort of there have been a reasonable amount of churn in this quarter in agency? Is it sort of a cleanup to an unproductive agent or something specific to it? Thanks.
Yeah, hi Avinash. On your first question, every business model, any company, even an FMCG, you will have differing margins, differing customer segments, differing interests, on differing objectives. And the same happens here. So these products are certainly not fungible. And we have to do a need-based analysis. Somebody might want zero exposure to volatility. Somebody might want all the upside. Somebody will want a lot more of protection. Someone will want to have wafer-thin protection. Some will want to have more health, and we have combination products. So many such avatars, and that's why it's only through engagement and finding out what is it the customer wants. And then, of course, margins also within that as to how much can we afford to sell. But it's both ways, and that's why we will continue to be nuanced. I think the fact that we have a balanced product mix, even when the going is good, has stood us in good stead time and again. For example, when we launched Sanchay Plus 5 years ago, it took a long time to be even understood, and now it is ubiquitous. But even at that time, when we were the sole company selling product like Sanchay Plus, we said we will have certain levels of limitations in terms of how much of this we want to sell, unless of course the customer really wants it, right? And reason for that is exactly this, that it helps cushion over volatility. It helps wean away our frontline sales from only selling one type of product, and then when the plug is pulled because of something or the other, it could even be like COVID, not just regulatory or macro. Then you kind of struggle to make a switch. And so our line is very, very attuned, and there's compulsory training in terms of being able to sell all types of products and genuinely being able to sell, not just a training that they go through. And so we don't really worry too much about it. I think we do innovate. So depending on what are the regulations that are now in existence, there will always be an opportunity. It might take a little bit of time for us to conceptualize and manufacture a product, but eventually we do with whatever cards are given to us, and whatever it is as a framework we are allowed to. So we have fair bit of confidence on ideating to be able to do that. And the nuances are always in the details. Nuances are always in levels of innovation, and we will continue to do that. So just now I explained on the surrender regulations. There could be something else that happens on par wherein we might have an advantage. Of course, that also comes under these regulations. Something on UL, for example, the profitability on our unit-linked products, again, without getting into too much detail, that has increased quite meaningfully from what it used to be maybe 2-3 years ago, which means that at 30+% unit link where we are just in standalone Q3, we don't excessively worry about it. And that kind of answers your question, that this is exactly what we're trying to solve, that in the existing construct, how is it that it still makes business sense for us to be able to sell all kinds of products. Right, so that was your first question. I don't remember what his second question was. Sorry, I don't know. Do you want to just mention it again, Avinash?
Yes. Second question was around churn in agents, because of course you have focusing on agents, but if I just see the count, there has been a big drop from Q2 to Q3 in terms of your individual agents. So is this some sort of a planned cleaning up of non-productive agents, or like what is to be read? Because I recall by H1 you had 210,000 odd agents, and now again the number is back to 190 or somewhere around that.
Hi, so this is Suresh Avinash. So just to quickly brief you, as part of our stated agency strategy, even to ID, there is a minimum business that we are expecting all our financial consultant partners to be able to deliver, and they are supposed to be active. Now, the industry does see a fair number of additions on the number of financial consultants, as well as some financial consultants who kind of attrite from this line of business. So what we have tried to do over the last few years is kind of ensure that the mix, even within the type of financial consultants that we onboard, whether it's chartered accountants, whether it's mutual fund distributors, whether it's retired, personnel, whether it's housewives who have wanting to do this as a career option, we try to kind of give a score and add people onto our number of financial consultants. And as and how we find people going on to alternate careers or not meeting the kind of requirements that we have in terms of quality of business, we keep it's not really churn, but effectively they don't fit into our business model and they don't hit our minimum business numbers. So that's the way we've been kind of looking at it. And of course, it's a question of how many new agents do we have, any catchment. So there's a fairly detailed strategy in terms of micro markets. Where do you want additional financial consultants? Which tier 2, tier 3 markets we are coming into? Where do we add those set of financial consultants? So finally, the objective is to make sure that, look, there are people who are keen on this as career, stay active with us, be able to sell the right product mix, have a productivity which is good enough for us to be profitable, make sure that at every club or till the MDRT, COT, TOT, we have a career line of path for our agents. I think that's the way we've been looking at building this channel, and which is one of the reasons why you have one of the best-in-class persistencies. You have probably a fairly strong relationship. We have financial consultant partners who've been there as high vintage for us. And we do believe that given as we expand to larger markets, this number will keep increasing on a steady state basis. So yeah, some will go up, some will go down, but that's probably true as long as we are able to attract the right profile of financial consultants.
Okay, thanks. One quick follow-up. On the group protection side, of course, sequentially there is some bit of softness. Is it more to do with credit life or GTI?
It is to do with credit life. I'm saying that because of the size. GTI is a lot smaller than where credit life is. GTI, as you know, that we are very calibrated in terms of opportunities that we see. There also has been a price normalization post-COVID, and we continue to see on a case-to-case basis whether it is rightly priced or not. As far as credit life is concerned, some of the RBI-led announcements we see a little bit of slowdown in disbursement, especially in some of the segments like auto and PL and so on. So while our attachment rates have not gone down, overall the disbursement itself has been a little bit soft. Not hugely, we still have grown over 20%, but yes, versus some of the earlier quarters, a little bit of that. That's the only big ticket reason.
Okay, clear. Thank you.
Sure.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Sanket Godha from Avendus Spark. Please go ahead.
Yes, thank you for the opportunity. I just wanted to understand the current our market share in HDFC Bank, point number 1. And second, if definitely it has improved compared to the last year, market share gain in HDFC Bank has not resulted in banca channel to do well. Maybe I can understand the direct channel or broker channel or even agency channel where high ticket size is an issue, where growth has not happened. But the banca channel, despite market share, the growth seems to be muted around 2% for third quarter at least. So just wanted to understand whether this short-term thing, what you said, the people are preferring more short-term products rather than the insurance long-term products is driving that moderation. Is the thing which I wanted to understand a little better from you. And second thing,
let me just answer this before you get, because I'll forget what your second question was.
Okay.
On this one, I don't know where you're getting the numbers from, because overall our banker channel, like I mentioned, grew 17%. So growth has been very robust in our banker channel. Just when I say very robust, just given some of the changes on the 5 lakh situation.
Vibha, I was referring to third quarter, specifically for third quarter. 9 months, I understand it is 16-17%. For third quarter, it seems to be weak. So that's the reason I was asking.
So third quarter was largely because of base effect. If you look on a 2-year CAGR basis, our bank assurance grew very well. Reason is, if you see, not just HDFC Bank, but all our other bank relationships also had fructified last year. So whether it is Yes Bank or IDFC First or Bandhan, and RBL, Saraswat, all of that did very well, and so the some of the base effect that was coming in on a normalized basis, that's not the case. Also, up to 5 lakhs continued to grow almost close to 20%, even in quarter 3. So again, for this year, you have to pardon my again saying up to 5 lakhs and above 5 lakhs, because quite expectedly the trends are very different. And so it is noteworthy that NOPs have grown by double digits in banker, and AP is grown by close to 20%, up to 5 lakhs.
I understand that point, Vibha, but my point was that I thought that this will be more than compensated by the market share gain in HDFC Bank. But I believe we have definitely gained
market share. Yeah, the market share has continued to be in the mid-60s, as against mid-50s that you saw earlier. So in that sense, that has happened, and year on year also that has grown.
Okay.
Right? So the slower growth is only attributable to above 5 lakhs. See, the above 5 lakhs, like you said, is enough to compensate in the market share gains. That is not the case, because the amount of the 5 lakhs was tepid in the first 2 quarters and then continued to move upwards towards quarter 3, and then of course quarter 4 we know what happened, right? So that impact is coming through. Suresh, you want to add anything?
Yeah, so look, I mean, quarter on quarter basis, obviously the banks also have their own focus on the CASA as well as on the other side of business. So while most of our banker partners have grown in line with the overall private bank growth, including HDFC Bank, it also, while we have consolidated our market share, there are these quarters up and down which will keep happening, and in some sense we have managed to maintain our market share, grown it over last year. We've grown the number of NOPs, which was more critical. The greater than 5 lakhs is what has probably pulled us down a little bit across some of the banker partners, because many of them have their wealth verticals which have got affected. But broadly, the trending in the direction in terms of how the banker infrastructure is growing and expanding, 2, our presence across all these banker partners, and 3, of course, the fact that we are gaining ground in terms of market share at H Bank and some of our new partners and additional new partners. I think that stays constant.
And to add there, the earlier comment, one of the earlier callers, wherein I talked about product mix and how we are looking at unit-linked products, that impacts bancassurance even more. Because banker does have 50-60% unit-linked products. So if you were to look at our share excluding unit-linked products, that is in the 70s. If I just were to look at that as a bifurcation, and so we will choose in terms of which segments how much we want to be present. And when some of this market exuberance goes down and our counter share continues to inch up, you will be able to see the overall growth. Right now, we are able to see growth in the segments that make sense to us.
Got it, Vibha. And the second question, which I wanted to check, was that when I look at our VNB walk, it says that 70 bits improved because of the product mix, and 80 because of it was negated by 80 bits because of the higher cost. So given if I look optically, the product mix actually deteriorated because your non-par contribution and par contribution has come down and ULIP has gone up. but you still say that from the walk point of view, 70 bits led to the improvement in the margin. So is it completely led by protection, or there is some other strategy like in ULIP you attach higher sum assured that played a role to see a margin expansion at the product level? And second thing related to it, when do you think this cost related thing will iron out? Because is it more to do with your cost on technology, what you highlighted last year, or is it because of negative operating leverage which is happening because of muted growth now?
So Sanket, actually you answered all the questions yourself. But starting with on the product side, it's margin delivery across all product segments has improved for two reasons. On unit link, like you yourself said, the amount of protection cover attached to unit link products has gone up significantly, both in terms of base sum assured as well as in terms of riders. Mm-hmm. Second, in terms of our persistency has also improved over the period of time across various channels. So that has led to better profitability compared to what it was in the same period last year on unit link products. Second, on the non-unit link products, our pricing discipline approach is something that does help us in periods where there is a lot of aggression in the market. We try and balance our growth and profitability objectives. So that is something that has helped us maintain and improve some of our profitability in the non-unit link segment as well. As far as protection is concerned, yes, you're right. So protection has grown both individual as well as credit life. So that continues to add to the value that we make, and the sum assured growth is an indicator of that as well. As far as cost is concerned, again, if you look at our overall expense ratio has been at the same level of last year, about 19.4, 19.5%. And the reason for this gap is largely because of, again, what you said, the operating leverage is negative right now because our planned growth is 15-17% in terms of what we capacitized for, but our delivery is short of that. So that definitely is a function of the operating leverage, which should rebalance once our actual growth is in line with what we are capacitized for.
And just to add to that, if you look at our new business sum assured for the quarter on retail itself, it's grown by 44%. So to some extent, what you had alluded to is absolutely right. That focus on protections at a sensible pricing is not just growing protection for the sake and having a price war on protection, but sensible pricing on protection and continuing to grow that is very evident in the summer as well. Have a net positive in terms of product mix profile.
Got it. Maybe just one small thing I want to squeeze. In individual protection, if I see on quarter-on-quarter basis, if I look at the second quarter, anything to read that the low base has already played out in first half, and now you will see a normalization of the growth path in the protection business. Is the right way to read it through the numbers or something else?
Yes, directionally, yes, Sanket. We did say that the base effect will be a lot more pronounced in H1 and will get normalized over H2. It is what is happening. So we still believe 20-25% growth is possible on a normalized base, and we're heading in that direction.
However, in terms of absolutes, I would not read too much in terms of a reduction. It might be a little bit here and there. We also react to competitive intensity, wherein it is wiser to withdraw rather than right close to loss-making business or margins that don't make sense or give up on underwriting. So a little bit of calibration you'll always find, but secular growth quarter on quarter should continue to be our target. But growth will also depend on what happened last year, and we have said that we should end protection growth over the next 3 years higher than company level growth. Will it be in the 50% range? Not if we want it to price it sensibly, but it should very comfortably beat company level growth.
Got it. Perfect. That's it from my side. Thank you.
Thank you.
Thank you. Our next question is from the line of Shreya Shivani from CLSA. Please go ahead.
Hi, thank you, and congratulations on a good set of numbers. I have two questions. First is on you put a slide on Bharat geographies, tier 3-4 cities. Can you...
Shreya, may I request you to use your handset, please? The audio is slightly muffled.
Is this better? Hello?
Yes, ma'am.
Hello.
Please go ahead.
Yeah. So I have two questions. First is on the the slide on tier 3-4 cities. Can you help us understand which channels do you think will help you grow better in those geographies, whether it's the agency channel, whether it's the banca or a combination of both? And also one question, as you expand into deeper geographies, what is the timeline that you think of when you will be able to deliver higher than industry growth now that you are pivoting your business model away into driving it in more into the smaller cities? Second is on the timeline for regulation. While you've mentioned a few things about the regulation, can you help us understand, is there any indicative timeline that you can give us that maybe it will get implemented in the next quarter, half year, or anything, any flavor around that would be useful? Thank you.
So, Suresh here. I'll answer your first question on the tier 2, tier 3 growth. Frankly, if you ask, we are looking at taking insurance across to tier 2, tier 3, across as many platforms as many partnerships as possible. And even if we start with, let's say, bank assurance, if you look at primarily with HDFC Bank, they're expanding into all the Suru markets, the semi-urban and rural markets. They're expanding by more than 1,000 branches last year. Right, you look at most of our other banca partners who are there are also expanding in. We have partnerships with many of the small finance banks and many other banks which are present in specific markets, whether you take the Ujjivan, Equitas, Utkarsh, Bandhan, IDFC, many of them are expanding. So clearly bank assurance is going to be one of the platforms through which we expand. Agency clearly is a channel which we believe we should be able to expand. We are adding 75 new branches. We are looking at seeing how we can appoint agents, in some of these newer models in terms of many of these upcountry locations where we should be able to take it into, and this is the first time that you would have seen that as a industry we have kind of created an agency structure which is look at tier 1 and tier 2, 3 markets. So our entire team has a dedicated vertical which is looking at tier 2 and tier 3 markets. It is not to say, firstly, I will also correct that we are not saying we're pivoting to tier 2, tier 3. I think we see the opportunity even in tier 1. So we will come out with both the products as well as the strategy on the tier 1 markets. There's no reason why we look at lesser productivity through banca in tier 1. We are looking at micro markets even within the tier 1 markets, and that is something that we're growing. It's just that we see that in tier 2, tier 3, we also have a significant brand advantage when it comes to customers looking at HDFC, which is a fairly well-known thing. Other than LIC and SBI, which typically have been there in these markets, HDFC Life clearly stands out in terms of awareness and consideration, and we believe we have the opportunity to go out there and grow. So now the question is how quickly we'll be able to take and ramp this up. I see with the banca presence, clearly we can expand fast, but with these our branches as well as our agents going into these markets, anywhere between 12 to 18 months, we should start seeing numbers expand. The third thing which I would also like to add is that, look, we do believe that through some ecosystem partners, we should be able to take a very different kind of product range to market. So if you remember earlier, we had looked at the Airtel tie-up where we were able to reach out through a Combi product. We were able to reach out to many of these markets. I think those opportunities will also come. So we will not let go of any of these opportunities to reach into these Suru markets.
Thank you. That's very useful. And on the timeline of the regulation, please?
So, Shreya, slightly difficult to answer that, but, the exposure draft is out. It's for, we are in the process of submitting our representation as a sector and some companies individually as well. And when we are very, hopeful and confident that we will have a chance of meaningful deliberation over the next few quarters. And I think depending on when the regulator is thinking of making this applicable prospectively, I think it's a function of how soon some of these engagements happen. But it's really up to the regulator to decide on this. But we do believe that the engagement is something that will happen, and also there will be we do hope that there will be some time available for making whatever transition that's required. And in light of our earlier conversation, I think there is no disconnect at all. We are all aligned in terms of protecting the long-term proposition as well as providing better value to early exit customers. So it's some technicalities that need to be discussed and deliberated upon. Once that is done, then I think we are good to go. But timelines, we don't really have a visibility on that.
Sure. So you mean that even if the regulation comes into place, if you have to change your product structure, etc., it will take some time to launch those new products as well, right? So it can be a little. This thing could actually play out over a couple of quarters in that case, right?
See, again, it depends on which shape and form the final final regulations come in. Just taking extreme scenarios, if it comes in the existing form, it will take a significant amount of product redesign, which will require some more amount of time for that. If there are some tweaks that need to be made, which aligns with the regulator and the industry objective, then it might be sooner. So it really depends on which form the final regulations actually come into effect. Yeah.
Okay, great. Thank you. This was very useful. Thank you.
Thank you. Next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Thanks for the opportunity. So the first question that I would like to pose is on the guidelines change. So over the last 2 quarters, we have heard that the commission rates have been changed across different channels. So just wanted to know what is the current status with this. Has the negotiation with all the channel partners come to a close, or is this something which could continue for the next 2 or 3 quarters? So that's the first question from Mr. Sagni.
I'll take that. So, more or less, we are past the EOM conversations. We are coming almost towards the end of the year. And, we look at it holistically with our partners, that it needs to be that it makes sense to the customer, it makes sense to the manufacturer as well as the partner. And those conversations have been had. I'm very happy to share that there's been no detrimental impact on the customer, and the partners also do understand that ultimately they're their customers, and it is important to be both fair, transparent, equitable to their customers as well. So that's really where we are right now, and don't really see any material impact as a result. We're just thankful to the regulator to have given us the flexibility to be able to see what kind of arrangements, what kind of contractual nuances that we can tweak with this flexibility. As long as overall akin to a TER, we have to stay within the EOM ratio.
Understood. And coming back to a previous comment that you made, that the ticket sizes below 5 lakhs have been growing at 3x the company level, which basically means 15%. And given you have previously indicated that above 5 lakh ticket size policies are around 11 to 12%, that would mean that the above ticket size policies, 5 lakh and above policies this year has contracted by around 2/3 compared to last year for the first 9 months. Is that the correct implication or
So the above 5 lakh ticket size business last year, I think on overall total AP, what we mentioned after the budget was around 12%. It's now around 6% of our total AP. So it's about, its proportion is now 6% of our total business, total AP compared to 12% last year.
Got it. That's very helpful. Thank you.
Thank you. Our next question is from the line of M.W. Kim from JP Morgan. Please go ahead.
Yeah. Thank you for taking my question. So I have the one question. I guess that's about embedded by your growth outlook. For last 9 months, 24, the unwind from the value in force is larger than new business value creation. So my question is, should we concern the potential slowdown on the EV growth in next 12 or the 24 months?
So NW, I think basically the two large components that will affect this are the unwind, which is upwards of 8%, and what has got impacted is definitely the VNB contribution. And the VNB contribution, given that we've held our margins, is largely a function of our APE growth. This year we definitely are at a lower level of APE growth than our capacity. So that is what is dragging down the embedded value operating profit, and that's at 16.5%. It's fairly close to where we were last year. The delta being a function of two things. One is the VNB contribution is lower to the extent of about 50 basis points, and the remaining 50 basis points is actually coming from the denominator effect. We had the preferential capital raised in the previous period. That has expanded the denominator, and that is giving another 50 basis points kind of a gap. So by the end of the year, we are expecting to be in the range of what we have been talking about in the 17+% range, and that's what we would aim to deliver in the coming years as well, once the VNB contribution stabilizes to the numbers that we've seen in the past.
Oh, yeah, that's very clear. Thank you. Just one thing. It's not really the question, but my understanding is that the regulator, the draft, looks too conservative in terms of the surrender by the related one. So my guess is that the India perhaps that may have the highest surrender value among the Asia countries if the initial draft were to be accepted. So I'm wondering whether do you expect any certain portion of the adjustment compared to the initial draft on this surrender value the related regulation, or you think that due to the very high customer protection, this largely makes sense based on the industry, the perspective. So I just want to get some sense about this.
So MW, I think in all fairness, right now we are still in the process of engaging with the regulator. We do understand their broad thought process in terms of protecting the interest of the customer, and we are all aligned to that objective as we discussed on the call. The regulator, of course, is aware of similar long-term products available both globally as well as in India, and the kind of trade-offs that an investor or a customer needs to make between guarantees and liquidity. So I think given that the overall
Ladies and gentlemen, please stay connected while we reconnect the management. Thank you.